Cat's bugging me.
Good morning. Let's start making our way to our tables.
Which, you know, again, so
Well, good morning. Thanks for coming to the kickoff of the 2022 Estate Planning Council presentations. Thrilled to have you all here. Hope you all had a happy holiday season, happy new year. We're thrilled to have a great speaker who I've been looking for some time. Chris Maines of Maines Law is going to talk about how to plan around residency in the state of California and avoiding California state income tax. But more on that in just a minute. Thrilled that you all could be here. We're slowly coming back together as far as attendance. A lot going on with COVID and variances and what have you, but I know every time we have one of our meetings and the people and everyone comes, it's like old home week. So I think everyone's sick of webinars, and I look forward to coming back together. Obviously, we've got a new location here with Loma Santa Fe, maybe a little bit easier to get to right off the 5, but a great spot. We've had meetings here since October, and we had a social event in October that went over real well. We're planning for another one maybe in February or so, and we'll keep you posted on that. Couple of announcements as we move forward. Again, we always meet the first Tuesday of the month. 7 to 9 in the morning if you're in person, 7:30 to 9 if you are Zooming in. I certainly want to recognize Chris Sitchell, who's the new CEO of Rancho Santa Fe Foundation, who's taken the place for Christy Wilson, and all the support that she gave the council. And congratulations to her on her retirement. So thrilled to have that happen. I want to bring up Robert Valera of Voight Real Estate, our sponsor for today's meeting. And here he is.
Thank you, Bill. Go ahead and click to the next slide. Oh, no, I'm sorry, I jumped you too far forward. There we go. We've got a handout out there also. I want to tell you a little bit about Voight Real Estate, a little bit about myself, and then I have an aha for you. Voight Real Estate Services, you've probably seen our signs all around the county. We're a full service commercial real estate firm handling multifamily, office, industrial, retail properties, and urban infill development sites. We've been serving Southern California since 1971, and the Voight name might be familiar to you, going all the way back to high school PE, playing with Voight balls. Same family, but we were very fortunate that Bob Voight did not want to stay in the sporting goods business. And he built up a tremendous brokerage firm. And we're very blessed in that about 7 years ago, Bob sold the firm to the brokers. So we're broker owned. When you're working with us at Voight, you're working with an owner, not a bureaucracy. We have offices throughout Southern California and here in San Diego and in Carlsbad. Go ahead and click up to the next slide. I come to you and work in the real estate industry with a technical background, much like many of you, attorneys, CPAs, financial planners. Came into real estate at a young age. As a student who had an interest in economics and studying economics, I found the field of urban geography. And that's where you study how cities grow and change over time. And as you can imagine, working with investors, being able to really get a jump on changes in neighborhoods. It's been a wonderful background. Since then, I've closed over 400 transactions. About 250 of those were tax-deferred exchanges. And it's all powered by a deal junkie's enthusiasm for the next deal. In San Diego County this past year, we ended up having a banner year in the investment property market, apartment sales, commercial property sales. Never would have anticipated that a year earlier. We're in the midst of a recession. You can see the transaction volumes there. Now, here's the aha moment. I've been working with investors for a long time. We're plotting investment returns. We have to pay attention to what's going on in the general economy. Fortunately, I do have a background in that. And one of the things I've been watching for over 20 years is the inflation rate. And between 2000 and 2019, Bureau of Labor Statistics was telling us that we are at a 1.9% average inflation rate. I want you to think back over the last 20 years, and not the last 12 months, but the last 20 years. 1.9% inflation. Does that match what was going on with your household, with your finances? My guess is it didn't. So where's the differential? Is there an error in the Bureau of Labor Statistics in their measurement of inflation? The US government definitely has a conflict of interest in terms of publishing inflation stats. They're borrowing money at interest rates that are going to be affected by inflation, and they're making payments, Social Security and others, that are indexed to inflation. Now, I think the folks at the Bureau of Labor Statistics are doing their best to play it straight. You can see we've had, if you flip to the next slide, we've had 3 periods of high inflation during the 20th century. Most of them were tied to wartime spending. When the Bureau of Labor Statistics looks at their basket of goods and changes in prices, the slide on the lower left, you'll see an outlier figure there. And that's their measure of housing costs. And it accounts for about 24% of the basket of goods that the Bureau of Labor Statistics is looking at to figure out what the inflation rate is. And the way they measure housing costs is something called owner's equivalent rent. They actually survey people and they ask, what do you think, if you're a homeowner, what do you think your house would rent for? And they ask tenants, what do you think your apartment rents for? And of course, tenants know what their current rent is. I want all of you to think, what would your house rent for if you were to rent it out right now? Put a number in your head. Okay. I'm willing to bet we're all low by a substantial amount. Want to play a little game with yourself? Go to Craigslist this afternoon. Find out what houses are renting for in your neighborhood. It might put, if you own the home, it might put a smile on your face. If you're renting, you're probably going to groan when you find out what other people are paying in your neighborhood for rent. That's the owner's equivalent rent. And the Bureau of Labor Statistics is using a figure around 1 to 2% annual increase in owner's equivalent rent. And we all, if you're not aware of what's happening in rents, last year, market rents were up by over 10%. And so Bureau of Labor Statistics has been consistently undercounting rent as they go through and compile their, I should say undercounting housing costs as they go through and compile their statistics. Finally, on the handout that you have, there's some exciting information about what's going on around San Diego, both in University Town Center, Sereno Mesa, and downtown San Diego. And those major developments that are referenced there are indications of future employment growth in San Diego. So it's good news all around. I'm looking forward to a wonderful 2022 and hope the same for all of you.
Thanks so much, Robert. Certainly want to recognize Robert, Glenn Arnold, Doug Wilson. They're all part of our team that kind of puts on our Planning for Real Estate Family series. You know, a unique estate planning challenge dealing with those kind of families. Property rich, cash poor, don't believe in stocks and bonds, and has some unique planning opportunities and challenges that goes with that group. Upcoming meetings that we have for the council, February 1st, of course, always the first Tuesday of the month. We have Carolyn Taylor of Weatherly Asset Management and Will Beamer of Dowling and Yonke, who are going to give us their perspective on where things are going in the investment and economy world going forward for 2022. Other events coming up on January 27th is the Rady Children's Professional Symposium, a great symposium that's in your meeting announcement. There's more information as far as who's speaking and a link to the registration page. On January 19th, the National Association of Estate Planners and Councils, which includes the Accredited Estate Planner Group, AEP. Lou Mazzullo is going to be talking with RJ Kelly here, one of our key members, on after all that, what still works in the estate planning world. certainly let me know if you need more information. I can email that to you, or RJ can, or you can go to NAEPC.org. Our February 10th to 11th, there is the Step Orange County 11th Annual Institute on Tax and Estate and World Economy presentation, which is always a great group. They're meeting in person, though limited numbers, but Larry Brody, Andy Katzenstein, Jerry Hesch, Jared Doyle, and Paul Lee, amongst others, are presenting. So certainly be aware of that. March 1st, the council has our next meeting that'll be led with a panel by Jenny Brad of Withersbergman. It's going to be also addressing 2022 planning after all the dust settles with the Biden tax legislation or not. Paul Hines and Aspirient, which is where Paul's firm merged into recently, they're going to be sponsoring that meeting. April 5th, we have an interesting meeting with Kristen Caverly and Lisa Roper of Henderson Caverly on death during divorce, the impact on spousal property rights. Always kind of an interesting one. I have a great friend up in Seattle, Wendy Goff, ACTAC fellow. She's going to be speaking in May, and her area of passion, besides the broad world of estate and charitable planning, is the challenges of drafting for beneficiaries with mental health and addiction issues. That's everywhere, amongst our clients. So that should be an interesting one to deal with there. Certainly our upcoming Hot Topics ladies are going to be back in the swing of things in February with Katie Swafford, Roberta Robinson, and Kristen Shepard. And real quickly, Pete, do you want to say a word about or two about the trifectas? Here's our master networker.
Thank you, Bill. And first of all, I want to say, everybody, I'm glad you're here. Isn't it great to be in person again? I mean, this is where business is done. About a year and a half ago, we started doing what we call the trifecta. And what I do is I pair you up with two other people, hopefully these people that are going to be complementing your industry, not competing. And you get together for coffee, lunch, breakfast, happy hour, a hike, it doesn't matter. But this is an opportunity for you to get to know each other more on a personal basis and on a professional basis as well. So if you haven't done so already and you'd like to participate in the trifecta, leave a business card at the front desk table where I was standing over there, and I will pair you up, and everyone can get together and do some more business networking. Thank you very much.
Pete, thanks so very much. Certainly want to recognize our good friends from the Jewish Community Foundation who, lucky for me, they reached out to us in April of 2020 and said we do webinars all the time, and they worked with us and hosted and put together our Zoom webinars over the last year and a half or so. Charlene Wallach and Ali Ben have been just a great help in making that happen. There's a flyer on the table about the JCF's newest initiative called Give For, which is giving together to save our community's toughest challenges. And the focus right now is homelessness in San Diego, which of course we know how bad that is. And they've got a great group of folks that have kind of come together in that regard. So certainly follow up with there if that's an area of interest for you all. Without any further ado, I want to introduce Chris Maines of Maines Law. Chris, I've been looking for Chris for some years as far as the ultimate expert on how to manage your residency so you are not a member, not a resident of California, and avoid your California income tax. Chris works out of Palm Springs. He's a graduate of UC Berkeley Law School, and in his 2 decades of experience in the residency planning, audits, and appeals arena, This is what he does 100% of the time. He's the guy. He has clientele centers on Silicon Valley startups, professional athletes and actors, expatriates working abroad, uh, business owners who are selling their businesses, or founders who are exiting their businesses through a sale or IPO, cryptocurrency investors, and traders. He's been interviewed in many different places, from the Wall Street Journal to Bloomberg to Forbes. Please join me in welcoming Chris Maines.
Thank you. Thank you so much. It's true that Bill kept asking me to do something. Am I on? Hello, am I on? I hope I'm on. Let's go. Let me see here. I'm on. Thanks. Sorry. Anyway, it's true. Bill kept asking me, and I finally succumbed, and I'm happy I did so. I used to be an estate planner, or rather the firm I was in did estate planning. We were in a boutique firm for many years. I was in a boutique firm, and what happened was I gravitated towards residency audits and residency appeals. And ultimately, that's all I did for about 20 years. Now I have my own firm that exclusively deals with residency tax planning. And is my audio working? Everything okay? David? Good. In any case, for the last 20 years or so, I've just been doing residency audits, residency appeals, and protests, and residency planning. My firm currently does almost nothing. It does nothing else than residency planning. Every once in a while, I will take on an audit or a appeal, only in a consultant capacity. I'm muted. This says I'm muted. What's going on? You can hear me. I just got a message I was muted. Anyway, in any case, that's all we do. And it's relevant that that's all we do, because as Bill pointed out to me, what happens is that people come to me with residency issues. There it goes. People who come to me, there we go. Now I can, anyway. I hope you're hearing me. I'm getting messages that the audio just came on. In any case, so people come to me with residency issues, or at least they think they have residency issues. That's because that's all our firm does. We don't do anything else. So they don't come to us with other issues. And that's not true for you. And CPAs and family offices and other tax attorneys, who are boutique and do a lot of other tax planning and a lot of other tax analysis and a lot of other tax disputes. It's not true of wealth managers. It's not true of family offices. And so Bill pointed out, and it really went to the heart of the issue, is what you're looking for is spotting residency issues that may be relevant to your clients, as opposed to what I do, and that is nobody approaches me, and I'm approached by dozens of people every week with phone calls and emails. And by the way, if you want to email me with a question or discuss matters, be my guest. Emailing is better. You can just go to my website. It'll be on the PowerPoint, which I'll start in a second. I'm happy to discuss matters. That's what I do all day. I discuss residency issues with people who call me up or have an issue, and they already have an issue. It may be that they don't need me, and in a large portion of them, they don't. They need a CPA. They need a wealth manager. They need a family office to handle issues like sourcing. So that's what this is about. It isn't a crash course in residency law. You can't do a crash course in residency law because it's so fact specific. It's so anecdotal. So you have to, so that's not what's going to happen here, but I am going to give you some of the basics and dispel certain myths, because there's so many of them on the internet about California residency. And hopefully the outcome will be that if you have clients who you have long-term clients and residency issues arise because people are leaving California at a higher rate, or at least high-income people are. Actually, the rate's about the same. There's another myth that people are abandoning California. That's just not true. But plenty of people are changing their residency or arranging their residency for purposes of tax planning. And if you need to spot those issues, or if you spot those issues, you can assist them. It may be that you don't want to advise them. Maybe you want to send them to me or somebody else and find the appropriate professional for them. But the point is, it's helpful to know what issues arise that make it relevant, their residency relevant. So having said that, let me go to my presentation. And I'm on the wrong spot. Let me go back. There we go. And I call it California residency tax planning. I call it a multi-professional approach. That's my pompous way of saying that what I just said. And that is residency tax planning isn't one thing. It isn't for one kind of firm. It has a lot of different dimensions, and it involves a lot of tax professionals. So first, let me give you a 30,000 foot view of residency planning, and then we'll move down to what counts, and that's what's happening in your practices. But you need to know these basic concepts, and that is there are different issues in residency planning. There's the planning issue, and again, that's all our firm does. We put together comprehensive residency plans, start to finish, for a fixed fee. We don't do anything else. I don't work on an hourly rate. I don't have an hourly rate. I do everything for a fixed fee and put together comprehensive plans. Again, once in a while I consult in audits and I consult in appeals, but they would have to be very large to make it practical. But that's not the only thing that happens with planning. And my clientele isn't the only clientele in the world that needs residency planning. The planning part is someone has decided to change their residency, and now they need input about that, professional guidance on that, or they're non-residents and they want to maintain their residency, their non-residency status, but they have to be in California. A lot of my clients are professional athletes, basketball players. A lot of them make films. A lot of them are executives who have to come to California for long periods of time to set up a branch of their company. So they're non-residents and they want to maintain, or they just have a vacation home in California and they want to maintain their non-residency. But planning is one aspect of it. Reporting is another. Reporting is something that CPAs do best. And I get a lot of calls from people who, especially with remote work being what it is, they want to know how do they report their income now that they change residency, or maybe they're just non-residents and now they're working for a California firm. I can't really help them with that. I mean, I can tell them the rules and I know the rules, but the person to help them is a CPA usually in that case. And often they have a dispute with their employer because the big firms, they don't really want to deal with this issue with remote workers. And so what they do is basically withhold when they shouldn't. PayPal does that. Facebook does it. The Silicon Valley firms, they tend to just do that. Google does it. And in one sense, I blame them. In the other sense, I don't. California doesn't use W-2 for withholding on state taxes. As you know, they use a DE-4 and a DE-9. And the DE-4 is so poorly written, it looks like a company would have to withhold on everybody in the world, no matter where they are, non-resident or not, if they are employees, and that's simply not true. It's horribly written. So I kind of can't blame them, but it results in CPA work, because what needs to be done is probably a refund needs to be filed at the end of the year. If they withhold, the only way a non-resident remote worker is going to be able to get the money back is to file a refund. They're going to have to file a California 540 NR anyway because they withheld. So that's not something I do, and I literally get dozens of calls on that, and I'm literally saying, no, you don't want me. So there's a whole area there that needs to be that can be useful to your practice. Finally, there's disputes, and let me just get in. Well, let me just mention the disputes. The disputes are appeals, 4,600 notices, and protests. There are lots of 4,600 notices. They go out usually in May of the year, after a month after the filings, or they go out the end of the year after an extension after October. And they send out lots of those. And most of them are not that important with the 4,600 notice. There are very few appeals in California residency. And when they get into the those are administrative. When they get into the real court system, it goes into Superior Court after that, and then it can go up all the way to Supreme Court. But those are very rare. There's hardly any case law in the court system, the judicial system of California and the country on California residency issues. Almost all of them are administrative, and there aren't even many cases on that. So that's part of the problem is the rules are ambiguous because they haven't litigated them to a full extent. And in some really important issues, like how you allocate capital gain under new regulations they put into effect recently, 2017, there's no case law on it, and it's difficult to understand what needs to be done. But I'll get to that. So let me go talk a little bit about planning and how that works. There are always preliminary, people come to me and they're calling up and they're thinking of moving out of California because they have an IPO. Most of my clients are in Silicon Valley, or they're selling their business, or they expect a large liquidity event, or they just want to leave in California and retire elsewhere. But there's preliminary issues, and those preliminary issues are whether that helps them tax-wise. Just because you leave California doesn't mean it's tax nirvana, and I'll get to that later. It depends if the income is sourced to California. And that's something that they need to have a CPA look at. I can tell them the rules, but somebody has to look at their books and records, and I don't do that. That's something that should be done on an hourly rate by a tax professional who's going to scrutinize their income sources, who has their balance sheet. So that's the kind of thing that is preliminary. So people call me, and I'm happy to discuss matters, but I turn them over to CPAs. And so you first have to determine whether this is really going to have the tax effect you want. So that's a preliminary issue. And once they get to changing residency, that's what our firm handles, but it depends. We'll get to that too. If there is, several $1 million at stake in taxes, then it's worth planning at the level that I plan. If it's only $500, if it's only a $10,000 of tax savings, or 20, or even $100,000, they may be better off just using a tax professional who will answer their questions at an hourly rate. So again, the planning aspect has a lot of different dimensions and can involve a lot of different tax professionals. Again, maintaining non-resident status. A lot of my clients are non-residents, and they have vacation homes here, other contacts, and that's what but they want to continue to be non-residents. That takes some doing. Relocating and restructuring their entities. Again, I get a lot of calls on that. They don't need me for that. They need a business attorney for that. They need a CPA to first determine whether, there's a lot of moving parts to relocating or restructuring entities involving we're talking about redomesticating in another state. The first issue is it worth it? It might not because California taxes in terms of where its sourcing comes from, which may be much more important than the $800 fee or the 1.5% on S corps. So someone needs to analyze that, and that's usually a CPA or a tax attorney. It's not something I can do because I don't sit down and I don't even have the skill for it, for looking over balance sheets, looking over books and records. That's something other people can do, but that's something that I get other professionals involved. The important issue is the timing of liquidity events and residency change. It makes a big difference, as I'll point out later. Residency is binary. It happens on a date. We know that because California requires you, when you leave California, requires a taxpayer to tell them when they left. And that's really important for allocating income. We'll get to the rules on that, and you probably know them just briefly. California taxes residents on all their taxable income. If they're a resident, California only taxes non-residents on taxable income if it is California source income. So if you have a liquidity event, if you plan to sell $10 million of stock from a merger and acquisition that you've acquired or taxpayers required, it makes a difference when you leave. And it makes a difference when the event occurs because there's timing issues. Again, that's something I plan for all the time. But again, CPAs may need to get involved to look at the tax history of the interest, because if the interest was acquired and it's let's say it's non-qualified stock options or any non-qualified interest like RSUs, it may not be capital gain. You have to look at the tax history. You have to look at whether an 83B election was taken. And so that's something a CPA does. And I tell my clients, talk to your CPA, give him your books and records, give him the vesting agreement, the vesting equity compensation plan. They'll review it and they'll tell you whether changing residence at this point will be meaningful. And there's other issues about the timing of the transaction itself, which we'll get to. And again, that goes to tax history, and maybe a business attorney needs to look at that. It's different. There's a difference between having a letter of intent and having a full agreement with the closing happening in 3 months or something like that after due diligence. It may be having an LOI. That's not the transaction. That's not enforceable. Having an enforceable agreement, having everything in place, may be that changing residency is too late at that point. So again, somebody's got to look at that. I can give people rules, but somebody's got to look at the actual files of clients. And finally, there's the issue of residency audit risk versus the merits of the case. And I can't emphasize this enough. You really want to, they're two different things. One thing is the merits of the case, people changing their residency or maintaining their non-residency. That's a whole body of law and you've got to follow it. The other issue is getting audited. And the things that result in audits, I'll get into that later, have nothing to do with regular audits. Residency audits are unique. They're in a sense, they're not even audits. As I'll discuss it later, what it really is a ledger. They really just ask you to list all your contacts with California, all your contacts with your new home state, and then they're going to weigh them. It's the fact that things weigh differently that causes complexity. But it's not a typical audit, and it's not caused by typical audit. It's caused by often crazy things, usually common mistakes. A client of mine got a letter the other day from the CHP. The CHP has a website, and on that website, they ask people to snitch on cars that have out-of-state licenses that, for whatever reason, somebody thinks they're supposed to register them. The concept is this: if you keep your car in California, you're a non-resident, and it's here for a preponderance of time. It's a preponderance rule, not a majority rule. You have to register. California takes that seriously because they get a lot of revenues from the registration. And so they have a program to check out-of-state licenses. If you're pulled over, for instance, or have an accident, and they'll start asking questions about your out-of-state license. They find out that the car has been here for 6 months or even 3 months, if that's where it's kept, if that's where it's used more than any other place. You have to register it. They fine you, which is usually not a big deal. It's a hefty fine, but it's not a big deal for my clients. So usually that's just, yeah, I'll get fined. But what happens next is they can report you to the FTB, and the FTB then inquires. They send a 4600 notice and inquires what's going on. What's going on? You have a car here. You may have a place here. Are you a resident or not? So those are the kind of odd things that cause residency audits. They're not caused by the typical issues of whether expenses are deductible or income that hasn't been reported, things like that. That's the planning aspect. And let me talk a little bit about audits, because it's really important, because the only thing that counts is how they do an audit. Okay, it's what they do in audits that you have to back engineer into how planning is done. And a lot of people, I've done hundreds and hundreds of residency audits over the years, and a lot of tax professionals have it. And you have to understand what they're looking for and what's going on in a residency audit. The first thing you need to know is California doesn't audit that many people for residency. I know there's a myth out there. It's one of the many internet myths that California is going to audit everybody who's high income who leaves California. And that's just not true. New York does, by the way. New York, if you're in the top brackets and you leave California, you leave New York, if you're probably going to get audited for residency. But that's because the New York rule is so simple. I mean, essentially, if you have a home if you stay in New York for more than 183 days and you have a home, basically you're a resident. There are other considerations, but that's all they have to look at. So it's really easy for them to audit you for residency. California isn't like that. California doesn't, no one thing makes you a resident. No one thing makes you a non-resident. Residency is determined by a complex comparison of categories and contacts. So they don't have the resources or the inclination to audit everybody. They could theoretically just get all the digital information from the assessor's office. Find out who owns vacation homes here. It's all there. And just send 4,600 notice to all those people. The problem is they'd get millions of them. And most of them, or a lot of them, just wouldn't go to anything. So they don't do it that way. They have a different way of auditing. Mostly they don't do anything. That's another myth, that they're watching you. I'll get to that. The FTB, when it comes to residency, it's like coral. It just sits there and waits for information to come in. And you'd be surprised what information they get. And then when they get certain kinds of information, they may send a 4,600 notice, or they may audit. But they're not actively looking for people. Sometimes people mention the Hyatt case, and it's kind of a notorious case that took a quarter of a century. It involved the guy who invented the integrated circuit. Anyway, he left California right after making, I think it was $90 million, or in the middle of it. Went to Las Vegas, and that case went on forever. He could have saved himself a lot of trouble just by moving a couple months earlier, but he didn't. In any case, they learned about that they learned about that in the newspaper. Okay, some diligent auditor saw it in the newspaper that this guy just sold his company for $90 million or whatever it was, and that's how they found out about it. But that's rare. That's not, the people aren't there. The FTB doesn't have the resources to look around and check up on people. But when they do audit, and here's the difference between New York and California, when they do audit, they're serious, because they have to use a lot of resources. They have a sort of a group, a stable of auditors who do nothing for the most part, but residency audits. So you meet the same guys over and over again, kind of get to know their personality, which is quite helpful in an audit. And they do, and those are the people who do it. It's not that big of a group, but when they do audit, it's gonna be a thorough residency audit. They wouldn't they wouldn't get to that point unless they're serious about it. So they're interested in high income people. The typical kind of audit right now, because there's so much capital sloshing around and so many IPOs and mergers, the typical person they want to audit are people who leave California shortly after an extremely large liquidity event, an IPO or a merger and acquisition involving 10 or 20 or $100 million. Those are the kind of people they want to audit. It's just worth their while. I've had to do several of those. By the way, none of my clients have ever been audited. When I say my clients, I mean people I plan for, but I've done hundreds of audits and I continue to do that. But those are people who bring problems to me. Now, look, my clients could get audited at any time. There's a 4-year statute of limitation, but they haven't. And I think it's because we understand what causes residency audits and we plan to limit exposure. So that's really important. So anyway, that's really important. You win 100% of the residency audits that don't happen. I always tell my clients that. So if you can avoid, if you can do what's necessary to avoid an audit, even if you don't have the best case, you're doing okay. The next issue that you need to look at in this universe of things and about residency law is reporting. And that's mostly a CPA situation. CPAs need to handle that. It has to do with sourcing income, multi-state returns, doing business in California. And I get a lot of calls from people, again, dozens of calls who have issues about sourcing because they're non-residents and they're remote workers, or they have investments in California. I can tell them the rules. Again, I can sort of sketch it out and figure it out. But somebody needs to look at their books and records and look at details. It depends whether they have pass-through entities in California. It depends whether they actually come into California to work, if they're getting W-2 income. Doing business in California, that's just a straight analysis. You just look at the regulations and determine that. And there are exceptions like Public Law 86, depends whether you're selling widgets or you're performing services. Most people are, at least most people call me, or have services or consultants. And I can tell them the rules, but really, truly, somebody needs to look at their books and records to see what they're actually doing and where their revenue sources are, where their revenue streams are. That's what they need to do. That's not something you want to hire me for. That's something CPAs should do, or other tax professionals if it gets very complex. So some of the regulations on doing business in California get really complex. And that bears scrutiny and analysis, and that's best that be done by a tax professional who looks at books and records. And the other issue is, federal taxes are almost always more burdensome than California taxes. The top rate in California is 13.3%. It's hefty, but federal taxes are almost always higher. And you don't want people call me about California taxes, but they really have an issue about federal income taxes. And again, that's something best done by typical tax planners, whether it's a tax attorney or it's a CPA or a family office or a wealth manager. Those are the kind of things that can best determined by those kinds of professionals. And finally, disputes. I've talked a little bit about that. And it's really important to understand that all these are related. So 4,600 notices, in case you don't know, if you don't file a tax return in California, and sometimes it happens when you're a non-resident, and sometimes it happens when you're a non-resident, that has to be handled. Most 4,600 notice, it's a request for tax return. So here's what usually happens. They get some sort of information tax return. A W-2, usually it's a 1099, often a 1098, and a tax return isn't filed. And somebody made a mistake. On the information tax return, they use a California address. Usually it's a vacation home or a former vacation home, or sometimes they use a professional's address, and they shouldn't if they're in California. So what happens is California, and if there's no tax return and they have a information tax return that has a California address on it, it's automatic. They just have an algorithm. They just send it out. No one needs to look at it. If it's more complex, if there's other information coming to them that may indicate that a non-resident is a resident, they haven't filed a tax return, so a examiner will look at it and send it out. But the point is, it comes to people, and it often comes to their vacation home when they're not there, and they often default. So that's a problem. And what they need to do is immediately go to their CPA and find out, do they have to file a tax return? It may be they have to file a California tax return. I usually get involved at 4,600 notice only if in a consulting capacity. I get a whole bunch of them at certain points of the year, right after taxes are filed, the 44, resident returns and non-resident returns. And a whole bunch of people call up. And usually it's nothing. Usually all they got to do is explain, I put my address on a 1099. I made a mistake. And then they know it so much, you can often just call them up. I often just say, just call them up and talk to them. And that happens so often that they often the case goes away just by calling them up. Though, if there's a lot at stake, you don't want to have people calling. You don't want lay people calling up the FTB, but it can be done. But then if that doesn't work, there's a questionnaire you fill out. The first thing you have to figure out is whether you owe taxes. Maybe you do. Maybe you have to file a tax return. CPA determines that. So I always tell them, take it to your CPA, have them look at that. And if you don't have to file, if they don't have to file a California return, then you have to fill out this elaborate questionnaire to show and give documentation to show that you don't have to file, you're a non-resident, you don't have to file a tax return. The problem is they ask about your income. And so what they're really fishing for is to see if you're high net worth or not. And if you are, then they might want to go to the next level, which would be an audit. So they either accept it, they send a confirmation letter, or they say, we need more information, we're auditing you for residency. And then if you go through the audit and you don't prevail, the next issue, you can then go to protests and appeals. Here's my point. All these things are related. The 4600 can lead to an audit. The audit can lead to a protest and appeal. And it's really important that you get everything correct at the 4600 notice level, because if you don't, you're stuck with it. If you make a representation, it's all under penalty of perjury. You're stuck with it for the rest of the case. And this happened to me a while ago, a long time ago, when a case was brought to me by a bond trader, not even a bond trader. There's a group of people who come up with elaborate bond methodologies for selling municipal bonds, for within the rules, which are very complex. And he came up with this great idea that allowed municipalities to, I forget what it was, use the interest on the initial amounts so that they could build hospitals and things. It was a good thing. But he made a remarkable amount of money on that because he got a percentage of it. And he then moved to Wyoming, and then he got audited, starting with a 4600 notice, then an audit. And the problem was, it's kind of remarkable. The higher up you go, sometimes the less documentation there is. Even though this deal was for hundreds of millions of dollars, there was no agreement. It's a handshake deal. He said that's how everybody does it, because they don't have time for that. Because these bond concepts, they come and go, they put them into effect, and then there may be regulation and they go out of fashion. So there's no time for lawyering. You just do it on a handshake. That's what he did. The auditor just couldn't believe that. They couldn't believe that somebody was making hundreds of millions of dollars on a handshake. But he says, look, if anybody stabs anybody in the back, they'd never get any business again. So that's what they did. The problem was, at the 4600 notice level and at the audit level, they characterized the income as a bonus. It wasn't a bonus. When it got to me, I realized it was a royalty. The royalty wouldn't have been sourced to California. The bonus was. And so we went all the way up to the SBE. The SBE did, the State Board of Equalization did appeals at that time. Now it's the Office of Tax Appeal. All the way up, had a trial, which is very rare. And basically they said, Chris, great, you got great stuff here. You have witnesses, but the CPA at the 4600 audit level said it was a bonus. We're just going to say it's a bonus. You can't say it's a bonus and then change your mind. And a bonus was sourced to work that he did while he was in California. He lost. It was, a big tax liability, like $9 million or something. Anyway, my point is this. While 4600 notices seem to be minor things, and they usually go, 99% of them go away, and they are minor. Nonetheless, you have to be really careful. CPA should handle it, but maybe if there's a lot at stake, they might want to do it in consultation with a tax attorney. Doesn't mean the tax attorney should handle it, and I don't even have my fingerprints on it usually. I just consult. But if it's a big deal, then you should be careful, because whatever you say in the 4600 notice, or whatever you say in the residency audits, you're stuck with it, and it can haunt you. And it can be a malpractice bomb, in fact, which I'll get to. Anyway, now let me get to opportunity spotting and just some of the fact patterns. Again, this is for firms that aren't specialist firms. You may be a specialist firm, but not in residency. I'm a specialist firm. Everybody who comes to me has a residency issue or thinks they do, but that's not true for you. So, but there may be residency issues for your clientele that are there and they don't even know about it. And these are the kind of fact patterns. If you have non-resident clients, who have vacation homes in California. They need a whatever. They're doing business in California, so they're using a California professional, and they have a vacation home. You have to be very careful. Vacation homes are a vector of residency audits, and that's because it's a really important contact. Usually, to be a resident, you have to have a home. You have to spend time and have a home. Those are the two categories that are really important. Having assets in California, sure, work in California, but bluntly, residents live in a home and they spend time here. And so a vacation home, and they make representations. Vacation homes have insurance policies that may designate that it's owner occupied. Maybe their mortgage was taken out, saying that they're going to live there. There's all kinds of things that happen with vacate. There's the property tax exemption worth a whopping $70, which almost everybody signs because they stick it under your nose in escrow, even if you're a non-resident. So if you have a client who has a vacation home in California, they're non-residents, that may bear scrutiny, especially if they just bought one, especially if they just bought a really expensive one. I have a lot of clients who are non-residents who buy expensive vacation homes, and they need real planning. But that can happen in midstream. And so that's something to look for. If your clients are California residents and they have a pending liquidity event, it's they've acquired either as founders or as key employees, lots of expensive stock, lots of appreciated stock, and they're going to sell it for $10 million. They may, if they're thinking about it anyway, want to move to a zero income tax state. Now, that doesn't end the matter, and we'll get to that. There's more to it than that. But if you have clients like that, you may want to raise these residency issues with them. Remote work, particularly if there's principals and key employees who suddenly wind up, they're non-residents or they've moved out of state, so now they're non-residents, former residents, but they continue to have earnouts with their companies, so they're remote workers, they get W-2 income. It's really important, especially if they have vacation homes, because then they're spending time in California. And I think you know the rule: if you're working in California for W-2 income, and you receive W-2 income, even if you're a non-resident, it produces California income, and it's got to be reported. And that might not even be that big of a deal, unless you're a basketball player or unless you're a movie star. For an executive, if they spend a month in California, it's a 1/12 of their income, but that might not be the big deal. The big deal might be they have vesting equity compensation plans. And it may be, if they're non-qualified, the time they spend in California working, that's going to affect the ultimate amount of taxes allocated to income allocated to California from their equity plan. So that's something they need to know. So if they suddenly start doing remote work, they decide that they're changing residency, or again, they're doing an earnout, you can point that out to them. If you have clients who have separate residency, so that's a situation where one client is a resident of California, one spouse is a resident of California, the other spouse isn't. It's very rare, but as a percentage of my clientele, my planning, it must be 10 or 20%. So if your clients suddenly one of them wants to change their residency to a zero income tax state, it seems always to be the husband. If that's the case, you need to tell them that there's complexities involved with that. They need to set up a separate household. We'll get to that. There's community property issues, because if they move to a community property state, their income is still allocated 50-50. If they don't have a prenup or a postmarital agreement, if they're going to be selling a business interest, it may be that it's community, and changing residency will still result in a 50-50 allocation. They still get a benefit, but the issue will be that they'll it's only 50% of the benefit they think they're getting. There's ways around it, but they got to plan for it. They got to see the issue, and if you see that in your client, you can tell them that. The temporary work in California. So a lot of people, software engineers, they were in California for a temporary amount of time. Again, my clients tend to be professional athletes or entertainers, but there's a whole host of workers who come to California for a temporary period of time. Sometimes it's just executives setting up a branch. If you have those clients and you're doing their tax returns, you need to tell them that there's a residency issue here, because depending on what they do, depending on how much time they spend, depending on the agreement, they may become residents. And if they have other sources of income, that's suddenly now been gathered in by California. So they have to be very careful. Residents moving abroad or another. If you have clients who live in California, but they're moving abroad, this happens a lot in fintech. There's a whole history to this. California, in the olden days, it was merchant marines. There's not hundreds, but dozens of merchant marine cases. Guys who left their family in California and went to sea for maybe 2 years straight. And there was a bunch of cases. Then there were cases of oil workers in Saudi Arabia. They left their family in California and worked there for a couple of years. Then it became more related to financial people going overseas for financial reasons, and that's where things are. California got fed up with that. The FTB got fed up with it. What they did is they have safe harbor provisions, and if you can follow the safe harbor provisions, you don't have to worry about your residency. You just have to follow the rules. Even if you have wife and children are at home, you can avoid having to pay taxes on your income earned abroad. So again, if you have clients who are moving abroad because they just got a great opportunity, they're going to work there for a couple of years, you might want to discuss with them safe harbor and other provisions. And residents and finally, residents with QSBS gains that are planned, for federal, they get the federal benefit from it, but California doesn't have QSBS treatment. And you might want to tell them that. So that might be a reason why they want to move to another state. That can make a big difference. That could result in them paying higher taxes in California than they pay at the federal level on a liquidity event. So again, these are the kind of things you look at with your current clients and then find out whether there's an issue there that you might want to discuss with them. So anyway, to summarize, there's, again, this pompous term, multi-professional. For residency issues, there isn't just one type of practice. There's different moving parts, different spinning plates, and that's what you can be on the lookout for. I think I talked a little bit about this, but let me just, I get a lot of calls, and part of what I need to do is make a distinction between whether what I have to offer is useful to them, and maybe they need another professional. And here, let me just talk about the clientele that usually don't need comprehensive planning, but they may need other professional guidance. And those are people who are moving lock, stock, and barrel out of California. If you sell everything, if you give up all your contacts with California, I guarantee you won't be a resident. The internet myths notwithstanding, the long arm of the FTB notwithstanding, if you actually sell everything, if you're willing to give up all your contacts, you don't have to worry about it. Now, there may be sourcing issues, but you may not need, taxpayers like that usually don't need comprehensive planning. Now, they may need a CPA to help them with certain questions that they have. And if they keep anything, that's a different issue. Then that might need management. So, and there may be questions about what it means to relinquish contact with California, especially in intangible areas like a bank account. Where is a bank account? So those are the kind of things. So that's the kind of residents that just looking at a question here. And I'm happy to look at that. There's a question here. How long must you be out of California after moving before the income or gains on sale might not be considered California income? Good question. I'll get to that, but let me just tell you, residency is binary. It happens on a date. It doesn't happen. It's not quantum. It doesn't happen over a period of time. And we know that because, as any CPA will know who has to file non-resident returns, you have to say when you moved on a date on Schedule CA of the California return. So theoretically, here's what you could do. You could move on January 1st to a zero income tax state and then sell $100 million of gain on January 2nd, $100 million of stock that isn't sourced to California, and it's not taxable like California. Now, I don't recommend that. Okay, that's a law school question. Obviously, and it's not obvious, but they'll know about it when you file your 540 NR non-resident return, part year return. If you move in the year that you recognize the gain, they'll know about it, because you have to file a 540 NR part year return. You got to tell them that you moved. You got to attach your 1040. Your 1040 has Schedule D. Schedule T has another little schedule which tells them how much gain you got from the stock sales and when it happened. And they just put 2 and 2 together. Somebody left California, and shortly afterwards, they recognized large amounts of gain which otherwise would be taxable by California. And so all they have to do is show, the shorter the period of time, all they have to do is show that the date that you said you moved isn't accurate, either because you don't understand the law, which is mostly the case, or you're not telling the truth, or you made an error. I'll get to that in more detail, but that's a really important question. But you have to understand that residency is binary. It happens on a date, and you have to report that date. And income that you receive or accrue prior to that date as a resident is California source income. Income afterwards, if it's not sourced to California, isn't subject to California income taxes. So that's a real important planning concept. And by the way, the concept is the closer in time, the more likely you are to get audited. That's why I said I have 1,000% batting average on my clients not getting audited. But I don't know if that's going to withstand what happened last year and the year before, when there was all this capital sloshing around, all these IPOs, all these mergers and acquisitions. And a lot of my clients moved and they got out of Dodge a month before they received tens of millions of dollars. That's now in the system. The FTB knows about it. And again, the proximity in time between the two events, the transaction and the recognition of a gain and the move, the more likely you are to get audited. Anything under 6 months is a real danger zone. Anything over a year is a safety zone. Anyway, again, the other things to look at is that may not be important for residency planning is residency moving to another high income tax state. I get calls from people who say they're moving to New York and they want residency planning. Why? If you move to Manhattan and you're in the top bracket, you're paying almost the same rate as California. It kind of doesn't matter. And there is a credit system. So you can wind up, but the credit system is that takes a lot of analysis between states. So typically, if you pay taxes, if two states claim you are a resident, and you pay taxes in both, typically California being the higher income tax state will allow credit. There's some complexities there, and you have to be very careful because you don't get a credit for everything. You don't get a credit for capital gains. You get credit for, or typically you don't get it for capital gains. You get it for income that is sourced to the other state. But leaving that aside, if you move to another state, you probably don't need that. If you move to Hawaii and you're not in the top bracket, you're probably paying higher rates in Hawaii than in California. That's another thing. California has the highest income tax rate in the country, but that's only on the top rates. In the middle rates, in the middle brackets, some states have higher income taxes. So this is usually an issue of people who are in the top brackets. If they're not in the top brackets, somebody has to look at their tax liability savings and make a determination whether they're better or worse off if they move to Hawaii or New York or Illinois or Michigan or any of these states that have a tax. Non-residents who receive W-2 income and they come to California to work. I get a lot of calls about that. So they're working, they're non-residents. They get a job working in California, usually software engineers, but again, can be entertainers. But that's all the income they're going to make, W-2 income. But if they're getting W-2 income and they're in California working, it's taxable. Kind of doesn't matter whether you're a resident or not under those situations. Now, if they have other sources of income, if their sources of income include non-California source income and they want to shield that, then that's something they have to shield. So that's something for you to look at. I get calls about children's tuition in the UC system or our state system. That's just a different body of law. It has nothing to do with tax residency. The rules for UCLA and the UC system and our other school systems that give a break in tuition for residents, totally separate from anything else. So it has nothing to do with that. I'm just looking at a question here. Good question. Everybody's asking good questions. If my client becomes a non-resident, it waits a year or two before sale of high value stock, can they move back to California? The answer is no. There's a 2-year rule. And well, the answer is yes, if it's more than 2 years. So that's the 2-year rule. The rule is this: here's what you can't do. You can't leave California for a short period of time. That's what they say, and come back after a liquidity event and then say, "What I did it when I wasn't in California." The reason is you never to change residency. You have to intend to change residency, and you have to have the intend to live permanently in another state. They don't ask you what you intend; they ask you what you did. If you move to another state, sell $10 million of stock, and you're gone for whatever 6 months, and come back, you never intended to move that state. You intended to avoid taxes, and so that won't do it. So that's an important issue. The case law suggests that if it's over 2 years, you can move back. You've been in exile long enough, so that's possible. But I would suggest not. I always tell my clients, don't move for 2 years and a day, because then you're in the same problem originally of people who have large transactions right after they move. All they got to do is show that you didn't calculate the day right. You didn't calculate your time right. So you really need to stay out of state for 2.5, 3 years. Anyway, these are the other ones. You can look at them for people who don't necessarily need a lot of planning, but they may need planning at an hourly rate situation from CPAs and tax attorneys. Let me move on here. These are examples of people with complex contact. Contact is the unit of residency. And my clients always ask, well, by contacts, you mean friends and family? No, contacts is anything that constitutes a contact with California used in an audit, okay? And that's all determined by case law and chief counsel rulings and regulations. It means your house. It means the time you spend. It can mean your family, though typically immediate family is the only thing that counts, your spouse and your minor children. Nobody ever became a resident of California because they had adult children here and they were visiting them, or even if they had a lot of friends here. Again, that's kind of internet myth. In any case, complex contacts with California involve people who are, founders, and they're exiting their company, but they got earnouts, so they have to be here, and they have a vacation home. People selling residency, I call them legacy businesses, brick and mortar businesses. There's a lot of complexity with that, and residents retiring out of state if they want to keep a home here. That can cause a lot of complexity. And you can see this for yourself. Non-residents doing business in California, non-resident locating companies, they also have complex relationships. But again, it often doesn't require comprehensive planning like I have. It requires people who can look at their books and records. So there is no, my summary, there's no such thing as a residency client. There's just a bunch of different issues with different people involving that. And so there's no simple type. Let me now get to residency tax law. There's two distinctions you have to look at. There's status and there's income allocation or sorting. If you changing your status is really complex. If you change your status, but all your income is coming from California anyway, you haven't done anything, because California taxes income from non-residents if it's sourced to California. Now here's the rule. You need to know this basic rule, and that is, if you're a California resident, California taxes all your income from whatever source, could be from the moon, if it's taxable, regardless of the source. If you're a non-resident, California only taxes your California source income. And if you're a part-year resident, they tax, there's a date where you change your residency, and all the income prior to that, if it is taxable, if it's taxable at all, it's taxable by California, subject to California income taxes. And the day after that date, if it's non-California source, they can't tax it. They can only tax California source income. What constitutes California source income, of course, is complex. But the rule here is, let me get into what this is kind of important. So I'm running out of time here. Let me talk about residency myths and malpractice bombs, because here's what you hear on the internet, and it's just not right. And if you're telling your clients this, it's a problem. So again, you're spotting issues for them. You want to, even if you're not planning with them, you want to tell them how things work. So if they do need to go to another tax professional, or you are advising them, that you're giving them the right information. The first thing is changing residency equals tax nirvana. That's just not true. As I pointed out, California has a high income tax rate, but in the top brackets, in the middle brackets, it's not that high. So, and in lower brackets, it isn't. And if you're comparing it with Hawaii or New York or other states, in middle bracket taxpayers may be worse off moving to Hawaii. So, there has to be an analysis. So the idea is, if you leave California, you don't have to worry about taxes anymore. It's just not true. And also, California doesn't have we have Prop 13. Texas has high income tax rates, high property tax rates. Okay. In any case, some analysis is required. It depends where you're moving. Another myth is that California doesn't have any residency tax rules. It's all subjective. They just look at you and determine whether you're a resident. That couldn't be further from the truth. California's bursting with rules. The problem is the rules are not intuitive. The rules have been built up over 100 years of black letter law statutes, regulations, which aren't, black letter law. That's just what the FTB says we need to do. Chief counsel rulings, audit practices, and nobody was at the wheel. So they just came up with these ideas that for a particular situation. Nobody's at the wheel. It doesn't add up. There's nothing intuitive about California residency rules. You just have to know the rules. And in your case, if this isn't your practice, like again, it's mine, so I have to know all the rules. You have to make sure you're not, at the very least, you're not telling people the wrong rules, like the 6-month rule. So I often hear this. People come to me and say, my attorney told me that if I just spend less than 6 months, I'm leaving California. If I spend less than 6 months, I'm a non-resident. That couldn't be further from the truth. There is no 6-month rule. There's a 6-month presumption, and it's hardly ever used. I have an article about this. You can just go to my blog. California doesn't do residency that way. If all you had to do was spend less than 6 months in California, it'd be really easy. California compares how much time you spend in California with how much time you spend in your home state. It's a plurality rule, not a majority rule. So you have to spend more time, in most cases, in your home state. So spending 6 months in California, 5 months in your home state, and the rest of the time traveling, you just lost in that important category, and you may be a resident. So there is no 6-month rule. Just avoid talking about the 6-month rule. The 6-month presumption almost never applies. I can get into that, but just forget about the 6-month thing. The concept is you want to spend more time in your home state than in California. And not only that, you want to spend a lot more time. If you spend 6 months in a day, minus a day in California, 6 months plus a day in your home state, all the auditor has to do, and by the way, they'll know about it if you're filing a non-resident return, because you have to say how much time you spend in California for any purpose. If they see that you spent 5.5 months in California, they have incentive to audit you, because they know people travel, and it may be that they're spending less time in their home state. So you not only want to spend more time in your home state, but a lot more time, 2 months, something like that, in order to avoid an audit. Avoid an audit. Remember, you win 100% of the cases, residency cases in which you're not audited. You don't win 100% where you don't. The never set foot rule, I get this a lot. The business people call me up. They're from New York, they're from some other state, and they've never set foot in California, but they're consultants or they're selling something, and they got a notice from California that they owe taxes. They probably owe taxes. Whether you set foot in California has nothing to do with 1099 income, zero. It only has to do with W-2 income. If you're doing business in California, you may owe taxes. You probably do. There are exceptions like Public Law 86, which is a federal law, which occupy the field for widgets. If you're selling widgets, there are situations where if you never set foot in California, and by that I mean you don't have a branch or anything here, maybe you don't owe taxes, even though you're selling in California. But if you're consulting in California and there's California customers, California clients, you probably owe taxes on the revenue that you get. Doesn't matter whether you set foot in California. So those are the kind of things you need to know about. The issue about selling your business is really important. A lot of clients think, and that's the old rule, you can just leave California, sell your business, and since you're a non-resident, you don't have to worry about the capital gains. That used to be the rule. It's fundamentally true. But the problem is California passed a regulation, and that regulation has made things complex. And that regulation says they're going to allocate capital gain from intangible income, sales of stock, sales of LLC interest, business interest, based on somewhat complex rules. You need to know that, by the way, because that's a real malpractice bomb. So it's something you just need to be able to mention to your clients if they're leaving California. The regulation is 25136-2. I have an article on it at my blog. Anyway, they don't seem to be enforcing it. But anybody who thinks they can just leave California and sell an entity interest needs to be talked to, that it may be that California will tax it. Now, if they're selling the assets, that's a different issue. The assets may be in California. If the capital gain is traced to California through an asset sale, then they're going to tax it. And that's, if you're a business attorney in California, you need to tell your clients that how you structure the sale makes a big difference. There's a myth about close of escrow. Oh, excuse me. The escrow myth is that if you change your residency before the close of escrow, you don't have to pay taxes on it if it's non-taxable income. That's up in the air. What the transaction issue? When do you receive the income is up in the air. Is it when you close escrow? Is it when you have constructive receipt of the proceeds? Is it when you have actual receipt? Or is it when you have an enforceable agreement? I think, based on general principles, it's when you have an enforceable agreement. So if a client sets up signs an agreement to sell his company, to sell his stock, and then it's all done. They're just waiting for escrow to close, and then he leaves California and sets up a residency elsewhere, assuming he can do it in a short period of time. He may still owe taxes on that because California has a right to argue that he had an enforceable agreement when he left, and that's sufficient. There's the stealth myth, and you see that a lot. People come to me and say, what if I just use cash? My attorney told me if I just use cash when I'm in California, I don't have to worry about it. I'll just pretend not to be here. You plan by planning, not by not planning. You can't pretend not to be in California. Why? Because if you have to report on a tax return, you'd be committing perjury to say you're not here. But even if you didn't have to file a tax return, a non-resident return, and they find out about it and they audit you, they're just going to ask you, how much time did you spend in California? It's a fundamental issue. If you say, I don't know, then you've just lost the case. You have to know. The burden's on you. So you plan by planning. You don't plan by pretending not to be in California. You plan by being in California a amount of time that is consistent with non-residency. Another myth is the FTB is watching you. The FTB is coral. It sits there and waits. Except for the Hyatt case where they saw it on newspapers. California doesn't even know you leave until you file a tax return. They are not watching you. That doesn't mean you have to be careful. And if you're audited, they'll know everything about you. They have plenary power to subpoena, talk to witnesses, and they're just going to ask you. So, but they aren't watching you. That's not the issue. The other issue is a criminal fraud myth. I get this a lot from clients. They ask me, am I going to, if I say I'm a non-resident, am I going to go to prison if I'm audited? And the answer is no. There's never been a case of criminal fraud in residency in California. There was, by the way, in the Trump case, the recent case, the CPA, he's facing criminal fraud in New York, but that's because it's so the rules in New York are so simple. He knew he was in New York more than 183 days. He knew he had a place there. So New York brings criminal fraud cases in residency. California has never brought a criminal fraud case in residency. Now, it doesn't mean they couldn't. And if someone stayed in California for 3 straight years and then lied and said they didn't, there might be a criminal fraud case, but that's never happened. Clients don't need to worry about that. You just have to worry about it's just too complex. It's too factually contingent for them to bring a criminal fraud case. The next issue is the intent myth. I get this all the time. Client comes to me and says, attorney told me that I can't leave California if I'm doing it to save taxes. That's just absolutely incorrect. You can leave California for any reason you want, including tax savings, but you got to leave. There's a difference between motive and intent. You have to intend to change your residency, and you have to intend to live permanently in your new home state. Again, they don't ask you what your intent is. Everybody would just say that was my intent. They ask you what you do. If you do things consistent with changing residency, you can have any reason you want. Your motive maybe you don't like the palm trees, and your motive maybe you want to save $1 million in taxes. Doesn't matter as long as you follow the rules. Another myth is that, and I mentioned it earlier, is that that it's complex, but you'll be double taxed. You can be double taxed. There's a credit system via various sister state agreements, and you just need to know that typically you won't be double taxed. However, there are complexities there, and you don't want to just say you won't be double taxed. 2 states can claim residency on the same taxpayer. So New York can say you're a resident, and California can say you're a resident. They have different rules for residency. Usually it all comes out in the mix, but because of the California's system of tax credits. However, not necessarily. So there are nuances here. So if you're CPA, you have to explain that you might not be double taxed, but it's got to be looked at carefully. So so if you don't, that can be a malpractice bomb. Anyway, getting back to this, residency is binary. So I mentioned this earlier. It's not quantum. It happens on a date, and that's why you can do planning. There's a little Schrodinger's cat. It's not Schrodinger's cat. It's not a quantum event. Doesn't happen over a week. Doesn't happen over a month. Happens on a day. It's just a question of getting everything done to show your intent to move on that day. That's complex. The underlying issue for California residency, the underlying law, is a closest connection test. The closest connection test, you see it there, is that the state where you have the closest connection during the taxable year is the state of your residency. Well, that's not very helpful, is it? It just isn't. That doesn't tell you anything. It doesn't tell you what it means to have closest connection. So what people do then is they go to the brag factors. And here are the brag factors. There are 19 of them. Sometimes there's 17. The Wegner case was nice. The judge was nice to us. He actually organized them into 3 categories. Official filings, here they are. You know what they are. Things like driver's licenses and voting. Personal and professional associations, you can just read them. You can just look it up on the internet. And physical presence and property. So that's what everyone goes to. The problem is it's useless, okay? The brag test is useless in determining residency. I'm not saying, and so the FTB doesn't actually use them in determining residency in an audit. Now, I'm not saying they don't show up. They always do. Every auditor will have the brag test. And by the way, this only happened in 2003. Before then, there were no brag factors. But every auditor's report will have the brag factors. And every case law will have the brag factors. But I've done hundreds of residency audits. They're never determinative. What's determinative is something totally different. And so you need to keep this in mind to reverse engineer what's going on. And in a residency audit, it's a ledger. That's what's really going on. They're going to ask you to look at all your contacts with California. They're going to look at all your contacts with your home state. And then they're going to weigh them in totality. The problem is not every contact has the same weight. and the rules that constitute that are simply non-intuitive. But I call it the ledger test. And so I think that's what's helpful, because once you know that that's what they do, then you know that's what you need to do. You just can't follow. It doesn't map. What they do doesn't map to the Bragg test. It doesn't map to those factors. What really counts are 6 issues, 6 categories. 6 categories are the most important categories. They compare your home. They compare how much time you spend. They compare where you work. They compare where your assets are. They compare where your immediate family is. And I mean immediate. I mean spouse and minor children. Nobody ever became a resident of California because they had adult children going to school here and they visited them a lot, or because they had lots of friends here. But that's what the internet myth is. That's what they're really going to look at. That's what a contact is. It's never really a case. And finally, representations of residency, what the Wegner case calls official connections. If you say you're a resident of California, you're a resident in some kind of official capacity. And so, the obvious ones: driver's licenses, voter registration. There's nothing magical about a driver's license. The reason why you can't have a driver's license after you change residency is because to get a driver's license in California, you say under penalty of perjury in the application that you reside in California. If you say you're a resident of California, especially under penalty of perjury or some official representation, not just loose talk, and you get a benefit driving in California, voting in California, you're a resident. It doesn't matter what else you do. If you get audited, they'll just ask, did you have a driver's license? Yeah. Did I vote in California? Yeah. You're a resident. Now, those are the obvious ones, but there's other ones that are critical. There's your health insurance. We have a state-by-state system. So to become a resident, to get healthcare in California, you get healthcare for the most part from Kaiser of California, Blue Shield of California. If you have a policy in California, a health policy, you got to change that. There's other things, the property tax exemption, it's worth $70 tops, but you got to get rid of it. The only people who can get it are people who say they're residents of California. Your home insurance, if you own a home here in California, it's designated. It's owner occupied, or it's a second home, vacation home, or it's income property, something. They ask for, in a residency audit, they ask for your homeowner insurance policy. If you said you're a resident, you got lower rates, they're just going to shake their head and say, well, you're a resident. So those are really important. That 6th category. In any case, the way you prevail in the ledger test is more, bigger, and better. That's the words you want to, in every category that counts. More, bigger, and better. So things like cars, things like, and that's why the Bragg test doesn't work. They say, well, if you have car registered in California, that's important, and it is important. It does come up. But if you have more, bigger, and better cars out of state, it's a ledger. You win in that category. So almost all my clients have cars in California. It's better to get rid of. It's better not to have a car in California. But if they're going to be here for a significant amount of time, they have a car in California, that won't make them a resident. If they have more, bigger, and better cars, so their Tesla is going to be in New Hampshire, and they're going to have 2 other cars there and just have 1 car here. They just won in that category. It doesn't matter that they have a car in California. So that's the concept: more, bigger, and better. You have to keep that in mind. I just got a question here. Real estate assets and profit sharing accumulate over the years. Can you receive those distributions out of a planned future without? The issue here is sourcing. If you have a profit sharing plan, if it's not qualified and you leave California and become a non-resident, and then you receive it becomes taxable, the fact that you're a non-resident will not prevent California from taxing. It's going to depend on whether it's ordinary income or not, and that's a federal issue. If you took an 83B election, it may be that you've already paid the taxes on it. And if you become a non-resident after that, and then you sell, and then you receive income from the appreciation, it won't be taxable. But the way to determine that, whether it's ordinary income or whether, and a deduction to the company, or whether it's capital gain. If it's capital gain and not sourced, And by the way, that regulation may source, that I mentioned earlier, may source it depending on what the interest is. But if it isn't sourced, then you're okay. And real estate, that's, a big problem. If it's real estate in California, it's a quintessential California source, California asset. If you sell it, it doesn't matter if you're non-resident or not. It's going to be taxed by California. If you do a 1031 exchange, even that's not going to help you because California tracks that. So they won't tax it immediately, but when you sell it years later as a non-resident, you have to report it and they tax the gain at that point. They don't let go. So the idea that California has claws in non-residents, that's true. They claw things back. But so that is a true situation. To getting back to this, the problem with the residency test is it's just not intuitive. What constitutes something weighty or not is not something that is intuitive. It's just a bunch of rules. You have to know all the rules. And again, this is not a crash course in learning all the rules. I know the rules because that's all I do. But you need to know it's an issue more than anything. And corollary rules are really important. And I wish I could get into that. I'm running out of time. But let me just say, what constitutes moving from California is, as I said, you have to intend to change your residency and you have to occupy an abode in California, out of state, with the intent to live in that state permanently. You can't buy a mansion out of state and not move and not actually physically occupy it. You haven't changed your residency. Until you turn the doorknob and move into it, you haven't changed your residency. And moving, what constitutes moving into a home is really complex. You would think they would have rules on that. They don't. When the FTB doesn't have clear rules on something, it's because they want people to make mistakes. So they don't have clear rules on dating when you move. Similarly, I mentioned this earlier, they don't have rules what constitutes the date of income receipts for residency tax purposes. For an estate that's focused on this, you think they would. They don't. And that means they're hoping people will make the mistakes. I already talked about the 2-year rule. One thing that's important is counting days. I know I'm running out of time here. You would think that a state so preoccupied with residency would have a definition of day for residency tax purpose. California doesn't. A day in the federal government does for residency purposes, but California doesn't. So that any time spent in a state counts as a day. So what happens is if you you can have theoretically more than 365 days. If you leave your state, get on a plane, come to California on the same day, you've spent a day in California and a day in your home state. Now, look, that's going to, in a real audit, it's going to be put into an other category. There'll be an asterisk. And if you spent most of the day in California, then it'll count most of the out of state. You're going to argue that as an advocate. But on the other hand, the auditor is going to argue if you spent most of the day in California, well, they're going to argue that. But here's the point. You don't want to have your residency determined by day counting. You want to spend more time in your home state, clearly, and by so much that you don't have to worry about it. That's what I always tell my clients. You don't want your residency to be determined by a few days in or out of the state. I mentioned this earlier. I encourage all of you to look at a CCR 25136-2 that has to do with allocating income from capital gains from intangible interest sales, i.e. LLCs, stock, etc. It's really important. They aren't enforcing this as near as I can tell, but they could enforce it. And so it's something you don't want to tell your clients, oh, just leave California, change your residency, and then sell your entity interest. You got to deal with this regulation, or you need to tell them about it. Vesting equity compensation plans, I think I mentioned that. The issue is whether it's sourced to California. If it is sourced to California because it's ordinary income and you haven't paid taxes on it, changing residency won't help you. The rules aren't that complex, and I always tell them, talk to a CPA about this. In any case, I wanted to, there's some special rules here like digital nomad. Well, we appear to have lost
Chris. The very last slide of his is an interesting one. It's a particular case.
Let's see here.
And it's worth a read. He doesn't give the answer, but if you're interested, get back to me and I'll share the answer with you all. Thanks so much for coming. Thanks to Chris. Obviously, he's the guy. Obviously, your CPA is certainly another key person in here in dealing with sourcing of income and that type of thing. But I think his intimate knowledge of the rules is just a paramount as far as using him as a resource. We'll see you the first Tuesday of January or February with Carolyn Taylor and Will Beamer. Thanks so much. We'll see you then.
There we go.
Thank you.